Look, I'm not going to sugarcoat this. What's happening right now in the gold market is something most people won't see coming until it's too late. And by then, the opportunity will be gone. Gold just crossed $4,000 per ounce. Let that sink in for a moment. $4,000. And here's what nobody's telling you. This isn't the top. This is just the beginning of something much bigger. But before we dive into where this is headed, you need to understand what's actually driving this move. Because it's not what the mainstream financial media is telling you. They'll say it's inflation. They'll say it's uncertainty. They'll give you these vague explanations that don't really mean anything. The truth is far more specific and far more urgent. Central banks around the world are buying gold at a pace we've never seen before. In the first half of this year alone, they purchased 415 tons of physical gold. Now, that's actually down from last year's record pace, but here's what matters. They're not slowing down because they want to. They're slowing down because there's a physical shortage developing. Think about that. The world's most powerful financial institutions, the ones with unlimited money printing capabilities, are scrambling to buy a metal that most retail investors are ignoring. Why? Because they know something. They've seen the writing on the wall, and they're positioning themselves for what comes next. Let me paint you a picture of what's really happening behind the scenes. The COMEX, which is the major exchange where gold futures trade, is showing something extraordinary. The ratio of paper gold to physical gold has never been higher. For every ounce of actual deliverable gold, there are hundreds of paper claims on that same ounce. It's like a game of musical chairs, except when the music stops, there won't be enough chairs for everyone, and the people left standing will be the ones holding paper promises instead of real metal. Now, you might be thinking, this sounds dramatic. Surely the system has safeguards. And you'd be right to question that. But here's where it gets interesting. Back in the early 1970s, we saw something similar happen. Nixon closed the gold window, ending the dollar's convertibility to gold. At that time, gold was $35 an ounce. Within a decade, it hit $850. That's a 2,300% increase. But this situation is different. It's actually worse, because back then, the United States had significant gold reserves. Today, while the official numbers say we have over 8,000 tons, there are serious questions about whether that gold has been leased out, swapped, or otherwise encumbered. The Federal Reserve has never allowed a full audit of Fort Knox. Think about that. The world's reserve currency is supposedly backed by the full faith and credit of the United States. Yet we can't verify the gold that's supposed to be there. Meanwhile, countries like China and Russia have been accumulating gold for years. China's official reserves show steady increases, but many analysts believe their actual holdings are far higher. They've been buying gold through back channels, through state-owned enterprises, through every avenue available to them. Why? Because they're preparing for a world where the dollar is no longer the dominant reserve currency. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with their expanding membership, are actively working on alternatives to the dollar-based system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And at the center of all this? Gold. Gold is the one asset that every central bank trusts. It has no counterparty risk. It can't be printed. It can't be devalued by a government decree. It's been money for 5,000 years, and it will continue to be money long after today's fiat currencies are forgotten. Now, let's talk about what this means for you personally. If you're holding cash right now, you're essentially holding a melting ice cube. The purchasing power of that cash is eroding every single day. The official inflation numbers might say 3 or 4%, but anyone who actually buys groceries, pays rent, or fills up their gas tank knows the real number is much higher. Your cash is losing value in real time. But here's where it gets even more concerning. The banking system itself is under stress. We saw what happened with Silicon Valley Bank and the regional banking crisis. The Federal Reserve had to step in with emergency lending facilities. They had to backstop the entire system, and that was just from rising interest rates. Imagine what happens when we have a real crisis. When confidence in the banking system truly breaks down, where do you think people will run? They'll run to the exits. They'll try to get their money out. And they'll look for something tangible, something real, something that can't be created out of thin air by a central bank. That's gold. That's always been gold. And that's why the smart money is moving now, before the crowd figures it out. Let me share something with you. There's a reason why every major investment bank, from JP Morgan to Goldman Sachs, has been upgrading their gold price targets. JP Morgan recently said gold could average $4,125 per ounce going forward. Goldman is even more bullish. These aren't gold bugs. These aren't conspiracy theorists. These are the most sophisticated financial institutions in the world, and they're telling their clients to own gold. But here's what they're not telling the general public. There's a difference between owning paper gold and owning physical gold. When you buy a gold ETF, you own shares in a fund that supposedly holds gold. But do you actually own the gold? Can you take delivery of it? In most cases, no. During a real crisis, when everyone tries to redeem their ETF shares for physical metal, what do you think will happen? The fund will suspend redemptions. They'll settle in cash, and you'll be left holding paper while the price of physical gold soars. This has happened before. In 2008, during the financial crisis, there were periods where you literally couldn't buy physical gold at any price. The dealers were sold out. The mints couldn't keep up with demand. And the premium on physical gold over the paper price exploded. We're starting to see early signs of that happening again. Premiums on gold coins and bars are rising. Delivery times are extending. The physical market is tightening. And here's the thing that should really concern you. The gold mining industry isn't keeping up. Gold production has been essentially flat for years. The easy gold has been mined. The ore grades are declining. It takes longer and costs more to bring new mines into production. So you have declining supply, or at best flat supply, meeting exponentially increasing demand. What happens to price in that scenario? It goes up, significantly. Some analysts are predicting gold could reach $5,000 within the next year. Others are saying $10,000 within the next few years. And the really bold ones are talking about $20,000 or higher in a true monetary crisis. Now, I'm not going to sit here and give you a specific price target. Nobody knows exactly where gold will go. But what I can tell you is this. The risk-reward ratio right now favors gold ownership more than it has in decades. The downside? Gold could pull back to $3,800 or even $3,500 in a correction. That's maybe 10 to 15% downside from current levels. The upside? If we see a real monetary crisis, if the dollar loses its reserve status, if inflation spirals out of control, gold could double, triple, or go even higher. That's an asymmetric bet. That's the kind of opportunity that doesn't come around often. And here's something else to consider. Gold isn't just about making money. It's about preserving wealth. It's about having a form of money that will still have value no matter what happens to the financial system. Think about your retirement accounts. If you have a 401k or an IRA, it's probably sitting in stocks and bonds. And maybe that's done well for you over the years. But what happens if we have another 2008? Or worse, your retirement could be cut in half. And if you're close to retirement age, you might not have time to recover from that kind of loss. Now, I'm not saying you should sell all your stocks and bonds. Diversification is important. But having a portion of your retirement in physical gold makes sense as insurance against the kind of systemic risks we're facing. And here's something most people don't know. You can actually hold physical gold in a retirement account. It's called a gold IRA. You can roll over funds from an existing 401k or IRA into a gold IRA without triggering taxes or penalties. If you're sitting on $100,000 or more in retirement accounts, this is something worth looking into. I've put together a free guide that explains exactly how gold IRAs work, what the rules are, and how to set one up properly. You'll find that in the description below. It covers everything you need to know about getting physical gold into your retirement account the right way. But whether you do that or not, the key point is this. You need to own some gold. Physical gold. Not paper gold, not gold stocks. Actual metal that you can hold in your hand or store in a secure vault. Now let's talk about what happens next, because the gold market is at a critical juncture right now. We're seeing a perfect storm of factors converging. You've got central bank buying at record levels. You've got geopolitical tensions escalating. You've got the dollar's reserve status being challenged, you've got inflation that's not going away, and you've got a physical shortage developing. Any one of these factors alone would be bullish for gold. All of them together, it's explosive. And here's what most people miss. Gold moves in long-term cycles. We had a bull market from 2001 to 2011, where gold went from $250 to $1,900. Then we had a correction and consolidation phase from 2011 to 2019. And now we're in the early stages of a new bull market that started in 2019. If this bull market follows the same pattern as the last one, we're only about halfway through. The really big moves typically come in the final stages, when the general public finally catches on and starts buying. Right now, gold ownership among retail investors is still relatively low. Most people are focused on stocks, crypto, real estate. They're not thinking about gold. But that's going to change. When it does, when the crowd finally figures out what's happening, the price will move so fast that most people won't be able to get in at reasonable levels. They'll end up buying at the top, out of fear and panic, instead of buying now when there's still time to position yourself properly. I've seen this pattern play out multiple times over my career. The smart money moves early, the dumb money moves late, and the people who wait for confirmation, who wait for everyone else to validate their decision, they're the ones who end up losing. You have to be willing to act when things are still uncertain, when the mainstream media is still skeptical, when your friends and family think you're crazy for buying gold. That's when the real opportunities exist. Not when everyone agrees with you, not when it's obvious, but when you have to have conviction in your analysis and the courage to act on it. And right now, the analysis is clear. Every indicator, every data point, every trend is pointing in the same direction. Gold is going higher, significantly higher. The question isn't whether you should own gold. The question is how much you should own and how quickly you should act. Some financial advisors recommend 5 to 10% of your portfolio in gold. Others say 20-30%. In times of extreme uncertainty, some even recommend 50% or more. I can't tell you what's right for your specific situation. That depends on your age, your risk tolerance, your financial goals, and a dozen other factors. But what I can tell you is this: 0% is probably too low. If you don't own any gold right now, you're taking a massive risk. You're betting that the current financial system will continue to function smoothly. You're betting that central banks will manage inflation properly. You're betting that geopolitical tensions won't escalate. You're betting that the dollar will maintain its reserve status. Those are big bets, and if you're wrong on any of them, the consequences could be severe. Gold is insurance. It's a hedge. It's a way to protect yourself against outcomes that you hope won't happen but need to prepare for anyway. You buy fire insurance on your house not because you expect it to burn down, but because the consequences of not having insurance would be catastrophic if it did. Gold works the same way. And here's the beautiful thing about gold. Even if everything works out fine, even if the financial system muddles through, even if inflation comes back down, gold will still hold its value. It might not go to the moon, but it won't go to zero either. Compare that to cash, which is guaranteed to lose purchasing power over time, or bonds, which get destroyed in an inflationary environment, or stocks, which can crash 50% or more in a bear market. Gold is the one asset that has preserved wealth through every crisis, every war, every currency collapse in human history. It survived the fall of empires. It survived hyperinflations. It survived depressions and recessions and everything in between. And it will survive whatever comes next. Now, I want to address something that skeptics often bring up. They'll say, gold doesn't pay interest. It doesn't pay dividends. It just sits there. And they're right. Gold doesn't generate cash flow. But you know what else doesn't generate cash flow? The cash sitting in your bank account. In fact, that cash is actively losing value due to inflation. At least gold maintains its purchasing power. An ounce of gold today will buy roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about the dollar? In 1920, you could buy a nice men's suit for $20. Today, that same suit costs $2,000 or more. But an ounce of gold in 1920 was worth about $20, and an ounce of gold today is worth over $4,000. So 1 ounce of gold could buy you a nice suit in 1920, and it can still buy you a nice suit today. That's the power of gold. It's not about making money, it's about preserving purchasing power across time. And in an environment where central banks are printing trillions of dollars, where government debt is exploding, where the very foundations of the monetary system are being questioned, that preservation of purchasing power becomes incredibly valuable. Let me give you another historical example. In Weimar Germany in the early 1920s, they experienced one of the worst hyperinflations in history. People would get paid twice a day because prices were rising so fast. They'd rush to spend their money immediately because it would be worth less by the afternoon. People who held cash were wiped out. Their life savings became worthless. But people who held gold? They survived. They were able to preserve their wealth and rebuild after the crisis passed. We're not in a Weimar situation today, but the principles are the same. When you can't trust the currency, you need something else. Something real. Something tangible. Something that can't be manipulated by governments or central banks. That's gold. That's always been gold. And that's why gold is moving higher right now. The smart money knows this. The central banks know this. The question is, do you know this? And more importantly, are you going to act on it? Because here's the thing. Knowledge without action is useless. You can understand everything I've told you today. You can agree with every point. But if you don't actually go out and buy some gold, it doesn't matter. The opportunity is here right now. Gold is still available at reasonable prices. The physical market hasn't completely tightened yet. You can still get metal without paying massive premiums, but that window is closing. Every day that passes, more people are waking up to what's happening. More people are buying. More metal is coming off the market. And the supply-demand imbalance is getting worse. At some point, and I don't know exactly when, but at some point, there's going to be a scramble for physical gold. Premiums will explode. Delivery times will extend to months. And if you haven't positioned yourself by then, you'll be too late. This is your last chance to get ahead of the curve, to position yourself before the crowd figures it out, to buy gold while it's still available and while the price, as high as it seems now, will look cheap in retrospect. I'm not trying to create fear or panic. I'm trying to give you the information you need to make an informed decision. The data is clear. The trends are clear. The risks are clear. What you do with that information is up to you. But I'll tell you this. Years from now, you're going to look back at this moment. And you're either going to be glad you acted, or you're going to regret that you didn't. The choice is yours. But the time to choose is now. Because this opportunity won't last forever. And once it's gone, it's gone. Gold is telling you something. The market is telling you something. The central banks are telling you something. The question is, are you listening? If you are, if you understand what's happening, then you know what you need to do. Get some gold, physical gold, put it somewhere safe, and sleep better at night knowing that no matter what happens to the financial system, you've got real money that will hold its value. This isn't about getting rich quick. This isn't about speculation. This is about protecting what you've worked your entire life to build. It's about making sure that your wealth survives whatever economic storms are coming. And make no mistake, storms are coming. The debt levels are unsustainable. The money printing is unsustainable. The current system is unsustainable. Something has to give. When it does, you want to be holding gold, not cash, not bonds, not promises from governments or banks, but real physical gold that you can hold in your hand. That's the message. That's the warning. And that's your last chance to act before this opportunity passes you by.